What is hedging? Hedging is a trading concept used to minimize losses or the amount lost when trading financial markets. To hedge in binary options is to open a position opposite to our current position, so having both a call and put option open on the same financial instrument at the same time. So in this video I'm going to give you two hedging strategies. They're both used when price ranges, and both strategies very much rely on support and resistance. The reason why I'm not going to give any hedging strategies for trending markets is when price trends, we know it moves in one particular direction, hopefully very strongly, and there's not much need to hedge a trend. If price is moving strongly up on the upside, we want to be opening as many call positions as we can to profit from that large movement. Whereas when price ranges, we have this up and downwards motion, and we have the potential to open a number of puts and a number of calls and profit as price moves up and down, but in a general sideways direction. So this is the first hedging strategy that I'm going to give you. First, you need to identify a range, being price moving in between a support and resistance. And quite simply, we want to open calls on support and puts on resistance. Now the reason we want to do that is we will hedge our position. So if we placed a call on this support, price then moves on the upside, reaches our resistance area, we could then sell a put. And the reason we would do that is because when both of these options expire, we can profit from both the call and put. As long as the support and resistance is held, 99% of the time price is going to close in between the support and resistance. So if our binary options expired here, price is lower than where we opened our put, and price is higher from where we opened our call. So in scenario 1, we have the potential of gaining double profit, and also there's a guaranteed win. One of these positions is going to win. Now let's look at scenario 2 using the same strategy. Price has moved up to our resistance, we placed a put. Price comes down to our support, we buy a call, and then this support is broken. We know support and resistance does break, it doesn't always hold. So this support is broken here, and here's our expiry, this long line here. So our call would have made a loss, but our put would have made a profit. So once again we have a guaranteed win. No matter what happens, we're guaranteed to win at least one of these positions. And our loss is dramatically reduced. The reason being, if we had just placed a call at the support line, we would have made a loss. Say we placed a $10 call, price closed lower on expiry, and we made a $10 loss. Whereas if we hedged this position and had a $10 put also, we would have made the $10 loss on the call, but we would have made a gain on the put, and say the payouts were 70%. We would have lost $10 on the call, but gained $7 on the put. So we would have only made a loss of $3. Compare that to $10, and hopefully you'll start to see the benefits of hedging positions. Once again, if we go back to scenario 1, if we had only placed a put, we would have made a profit when the option expired, but we would have made double the profit if we hedged the position. Let's look at another hedging strategy, and this time let's use the example that support or resistance is broken. In this hedging strategy, we've placed a put on resistance. Price has then broken that resistance, and we know more often than not that when resistance is broken, it can become support, and when support is broken, it can become resistance. The whole ceiling become floors, floors become ceiling concept. And we also know that when a support or resistance is broken, price often comes back to that support and resistance to test and then bounces off. And that's what we have in this illustration. Price has broken the resistance, it's come back, tested the now support, and then gone on the upside. So if we had placed a put and it was on this resistance and it wasn't already hedged, when price breaks this resistance and comes back down to this now support and a similar area to where we placed our put, we can place a call option and hedge our put. When these options expire, we have a guaranteed win. Our call is a win and our put is a loss. If we did not hedge our put and price broke on the upside, we would have simply just made a loss. Once again, if we had a $10 call and a $10 put, without hedging we lose $10. With hedging we only lose $3. So let's look at these examples I've given you on real life price charts. This is the Euro US dollar, it's a 5-minute chart. If you're interested in hedging ranging markets, or if you're not interested in hedging but are interested in trading ranging markets, then overnight sessions of European and the US currencies are great for ranges. So this is an overnight session in London or the Sydney-Tokyo session, and price is ranging on a 5-minute chart. So we have a number of opportunities to hedge positions: call, put, call, put, call, put, call, put, and then another call here. And you'll see it's not until the start of the London session, which is round about here, that price actually comes out of this range. So it's very likely we could have made double profits on all of these call and puts using the hedging strategy. Let's look at a longer term time frame. Let's go to a daily chart for those of you who may be interested in trading binary options on longer term time frames. So let's do the pound against the US dollar and look at recent price action. Zoom in a bit. Here's our resistance. Here's our support. Price comes up to this resistance. We could sell a put option, especially because we have a bearish engulfing candle there. Price breaks out of that resistance and then comes back to test the resistance, now turned support. So there's our signal to open a call position, and as price moves on the upside and our binary options expire, we have reduced our risk, as we have one guaranteed win, which will reduce our loss, rather than placing a put option here and simply making the loss without having a win. Reducing exposure. I have two tips or two bits of advice for reducing exposure. First of all, splitting positions, and then portfolio diversity. So let's look at splitting positions, and let's go back to one of the illustrations I used for a hedging strategy. When talking about hedging strategies and using this illustration, I used $10 as an example of a call and a put, but we can reduce our losses and reduce market exposure if we split our positions. So if we're looking to place $10 per call and per put, it could be that when price reaches this support area, we place a $5 call. And then when we have a confirmation signal that the support is being held, say a bullish engulfing candle or bullish pin bar, or price starts to move on the upside, we could then place the remainder of our position, the other $5 call, and that's our $10 position opened. On a put, when price reaches this resistance area, we could place a $5 put instead of the full $10. Once we have some sort of bearish confirmation that the resistance could hold, we would then place the remainder of the position another $5 put. Now the reason for doing this is the more signals we have that a support and resistance is going to hold, the more likely we will profit. If we placed a $5 call on a support and it didn't hold, we've only lost $5, not $10. Whereas if we placed a $5 call, waited for the confirmation, then placed the other $5 call, we still make the same amount of profit as the $10 position, but our exposure and loss is minimized until that confirmation signal is given. My other tip for reducing exposure is to have portfolio diversity, so to trade a range of financial markets. We have focused a lot on currency pairs or forex in these videos, and a good portfolio could trade the following currency pairs: the euro, Japanese yen, Australian dollar, New Zealand dollar, pound against the US dollar, and US dollar, Canadian dollar. The reason why that may be a good trading portfolio is it has exposure to a number of currency pairs, not just a single currency pair. A portfolio I wouldn't suggest would be something like the Australian dollar, US dollar, euro, US dollar, pound, US dollar. The reason being you have a large exposure to the US dollar. And all of these currency pairs have strong correlation. So if one moves down, it's likely the others could also move down. If one moves up, it's likely the others could also move up. Whereas in the first example, there is very little correlation between these currency pairs. If you're interested in trading other financial instruments apart from Forex, such as indices and commodities, a good portfolio could be something like this: US dollar, Swiss franc, an indice, UK 100, and then a commodity, oil. A portfolio I wouldn't suggest would be gold, silver and copper. The reason being, once again, there's strong correlation between these markets. They're all precious metals, and we want to reduce our exposure, particularly to one currency, one category of commodity, etc.